Okay, welcome everybody to Finance 334. This is week 2. Hopefully we'll have some people join a little bit later, but if not, that's okay. Hopefully you'll all be able to review this session later in this week. So I've had a couple questions, and then I noted when I looked for the ebook that the ebook is not as straightforward in this course as far as finding the material. The ebook link is under modules. If you go under modules and then it gives you an ebook link. Most classes it's under pages, and for whatever reason it's under modules. If you have a hard time getting to it, just poke around on the site. Most of you have been able to find it, I think, but if that's keeping any of you from getting into the assignment for week 1, let me know. You'll need the material from the chapter again this week for the assignment for week 2, and so we need to make sure that you can get into the ebook and that you have full access to both chapters 13 and 14, which is the material for this week. All your grades are in. You probably saw that note from yesterday. As far as anything that's turned in on time, you guys have been graded on it. I thought it was a great week on the discussion board. Although when I got to the assessments and assignments, I was a little bit discouraged because there were quite a few of those missing. Like I say, hopefully it's just an ebook thing or just some issues, and you plan on getting caught up right away. But if not, if something else is holding you back, or you're stuck in some way, or feel overwhelmed at this point already, zip me a quick email. It's not that I can make everything better, but perhaps we can make a plan to get caught back up, get you unstuck, and make sure to get you on track for the course. Like I say, most of you did an excellent job on the discussion board. Just need to get those assessments and assignments completed. And of course, and I'll be posting Lindsay's information again tonight, but Lindsay's information I posted last week. She's the learning coach. She's been doing these finance classes for a few years now. She does a great job, and she can help you out. So make sure and use her as a resource as well if you are not able to get in touch with me in a timely way, or if you'd like to set up a time to have some one-on-one help. All right, as far as this week is concerned, we've got what's referred to as a midterm, although it's not comprehensive. It's a test this week that's got 20 questions, so more questions, 25 questions. And so there are more questions, but they're primarily based on chapters 13 and 14. So if you feel comfortable with chapters 13 and 14, you should be in good shape for the test. I will anticipate or plan on reviewing for the last 10-15 minutes of this class the question topics that you'll need to know for the test, so that you can do some more focused study throughout the week as you go through the chapter. All right, so this week on the discussion board, we're going to be talking about annuities and pros and cons and advantages, disadvantages of annuities. Once again, just as a reminder, the discussion board is a place for you to pose opinions, to demonstrate research, but primarily it's to formulate and describe your opinions as you feel them. So once again, no right or wrong answer as far as your opinions are concerned, but please make sure the focus of both your main post and your responses are your opinions that you form from the research that you've completed, so that the bulk of your post is more about what you think about the material that you found, and less about just cutting and pasting or regurgitating what you found. Okay? So that's the discussion board for this week. We're going to be learning about annuities. Hopefully last week on life insurance was interesting. As far as the assignment this week has some math problems and some questions as far as calculations on the cost of insurance, and then some other questions about taxation of insurance and things like that, all of which you can find in chapter 13. So make sure, once again, some of you got a little bit tricked up by the assignment last week, and I'm pretty sure it was only because you just hadn't looked to the chapter. You're just trying to find answers online. The chapter is always the best place to reference when it comes to getting answers for the assignment. Doesn't mean you can't get it right by finding things online, but a few of you got tricked up a little bit looking online, I could tell, instead of referring back to the chapter. The chapter is going to be a little more straightforward because they're the ones that came up with the questions. So this week, like I say, you've got some short answer questions, some calculations that you'll need to refer back to the chapter for. And so, like I say, if early this week you're not able to access the ebook, let's make sure and be in touch with the school and find what we need to do to get into the ebook, instead of just trying to find answers online and not always getting to the right solutions. As far as tonight, we're going to be covering chapters 13 and 14, as I mentioned, and spend a few minutes at the end going over the test. Keep up on your checkpoints and know that the assignment discussion board this week are pretty straightforward, but the assignment in mods past has been something that has tripped people up, especially if you wait till last minute on Saturday night. It's probably not something that you're going to want to put the effort and time and energy that is necessary into that assignment. So I would just strongly encourage you to get an early start on it, read through it, at least understand what it's asking for, so that when you look back to the chapter, you can take some notes either from the slides tonight or from the chapter on what you're going to need to know to complete the problems that are on the test. Okay, so chapter 13 is about buying life insurance. We're going to talk about a couple different things, but the first and most important thing about life insurance that we need to be pretty clear on is the cost of insurance. And why would we spend time trying to determine the cost of insurance? These calculations are probably not something that you're ever going to have to manually calculate again, but they are important and interesting when it comes to comparing one life insurance policy versus another. Back in my life insurance days at Northwestern Mutual, I used to talk to people about getting traditional whole life insurance once in a while, and they would talk to me about the cost of insurance, and they'd say, okay, how much is it? I'd tell them how much it was, and they'd say, wow, that's really expensive. Traditional whole life insurance is expensive. And my comeback to that was, if you calculate out how much cash you're going to get in return, how much cash value you'll have, the actual cost of insurance on a whole life policy is many times less expensive over your lifetime than it would be to buy term insurance over your lifetime. You don't get anything back for term insurance, where with whole life, at least you'll get some value back and some return over time. But that only works if you've got a good insurance policy with low costs through a good company, right? So how do you determine whether or not one policy with one company at $200,000 of coverage and $100 a month, how is that different from another company that charges you $99 a month for the exact same amount of coverage? Well, you and I as consumers are conditioned to always go with the lowest cost, right? If things look the same, we're going to go with the lowest cost. When it comes to traditional whole life insurance, they may look the same, but they are very different depending on which policy you're getting and depending on the features of that policy and perhaps most importantly, the crediting rate and insurance costs from one company to another. So how do we even know what those are? Because that's not something that insurance companies usually throw out there in their illustrations. Well, there's some resources that we can look at, but we can also determine the cost of life insurance through using some different methods and then compare those methods if we wanted from one company to another. So one's just the traditional net cost method of life insurance. And in this particular one, you take the total premiums that you pay in. Okay, so in this particular case, it's like $220 a month. So after 20 years, you paid in $2,642. Okay. That'd be more like $110 a year. But anyway, then you subtract all the dividends that you receive from that number, and that gives you net premiums that you paid in, because dividends are just technically a return of premium to the policyholder. So that's step one. Take the total premiums, minus out the dividends, and that gives you the net premium. Step two is you subtract out the cash value at the end of 20 years. That gives you the net insurance cost. Step three is you divide by the amount of years. Okay. And in this case, it's 20 years that you paid in. Okay, so you divide the negative 251 by 12.55. And then you're going to divide by the cost per $1,000 of coverage. So in this particular case, we're talking about a $10,000 policy. Okay, and that's why we divide by 10. If you were talking about a $100,000 policy, you'd divide by 100. Okay. If we were talking about $1 million policy, you divide by 1,000. If we were talking about a $50,000 policy, you divide by 50. Okay. If you were talking about a $5,000 policy, you divide by 5. This final step, well, these final two steps, I should say, step 3 and step 4, where you divide by the amount of years, and then you divide by the thousands of coverage that you're talking about in the equation. These are the two steps that trick people up the most when it comes to this week's assignment. This week's assignment is going to force you to demonstrate that you can do all three cost methods for life insurance. And when it comes to the traditional cost method, this should be your easiest one. Once again, step 1, okay, you just take the total premiums minus the dividends. Step 2 is you take that net premium number minus the cash value. Step 3 is you take the cash value, the net cost after you netting out the cash value, and you divide by the amount of years into the policy that you are. Okay. And then finally, you divide by the thousands of coverage. So in this particular case, once again, we're dividing by 10 only because we're talking about a $10,000 policy. If we would have been talking about a $100,000 policy, we'd be dividing by 100. Okay, and that gives you your cost. per $1,000 per year for coverage. Okay, so this particular policy, based on the traditional net cost method, costs us a negative $1.26 per $1,000 per year of the policy. The more negative the number on this traditional cost method or any of the cost method numbers, the better, right? Because in essence, it's saying the insurance company in this case is paying you to have this policy if you'll go 20 years or longer. That's why it's a negative number. But reality is, and this is why there are other ways to calculate premiums or cost of insurance, reality is there's a time value of money, right? And nothing in this traditional net cost method accounts for the time value of money. So what we're going to find is the other two methods that we talk about are both going to account for time value of money. So let's take a look at it. So this one's the surrender cost index, and this one does account for time value of money. The first one that we say is the total premiums that we paid in, okay, but we have to accumulate them all out at a certain rate. In this case, in the case of the problem on your assignment, in the case of this problem for the slides, it's going to give you what that rate is, okay? So what are the premiums calculated out at a 5% interest rate? So that calculation is a future value calculation. You can do it in Excel, or you can do it on a financial calculator, or you can do it in Google. Just Google a financial calculator, put in current value 0, put in the premium, the annual premium amount, okay, that the book gives you. The time period is 20 years, and the interest rate is 5%. You solve for future value, and that gives you $4,586. So that's your total value. Notice the difference in step 1 from surrender cost from traditional cost is just that you're accounting for time value of money and surrender cost, and you were not in the traditional cost method, okay? So then you subtract out the dividends, and the dividends you're going to discount for the 5% time value of money, okay? So you discount out the time value of money adjusted dividends from the time value of money adjusted total premiums, and that gives you the net premium. So that step 1 is very similar, it's just the numbers are different, right? And then step 2 is the same thing. You subtract out the cash value at the end of 20 years. This doesn't have to be adjusted because that is a future value number already, right? So you subtract that out. Then you get your insurance cost for 20 years. Notice this is a positive number this time because we've accounted for time value of money. Then we're going to divide by something different this time. We're not going to divide by the amount of years. We're going to divide by the function, okay, of a dollar deposited at 5% a year for 20 years, okay, which the book gives you the answer, and so does the sample problem in the book that we're going to be doing for the assignment this week. You don't need to calculate that out. It's going to give you that. So if we grow a $1 deposit at 5% per year over 20 years, we'll have $34.72 basically. That's the number we divide by our net insurance cost, which is 1468, and then our answer as far as an interest adjusted cost per year is $42.28. And then we divide it by the cost per thousand again, which is the same step, right, as it was in the traditional cost index method. So we divide by 10 because we're talking about $10,000 premium or policy, and we get the cost per thousand per year of insurance with accounting for time value of money. Okay, so really quick, we talked about 4 steps on the traditional cost index method, traditional cost method. Surrender cost method has 4 steps as well. Step 1 is different because you account for time value of money. Step 2 is the same because you just take out the cash value, right? Step 3 is different because this time we use a function of how a dollar could grow over 20 years or however many years the problem is. And step 4 is the same because we just divide by the thousands, right? However many thousands we're doing. So steps 2 and 4 are the same between these 2 methods. Steps 1 and 3 are different because this one accounts for time value of money. Okay? You're going to be doing all these methods on the assignment this week, so take a good hard look. Now, then we get to the net payment cost index method, one that also does account for time value of money. However, it does not account for the ending cash value, as you can see. So what have we done here? We've taken out step 2. Everything else is exactly the same. Steps 1, 3, and 4 are the same as the surrender cost index method, which was that second method that we talked about. Okay, steps 1, 2, 1, 3, and 4, excuse me, are the same. Step 2 is different because we don't take out the cash value, right? You don't see any subtraction for cash value. So it's just eliminating step 2 when we talk about the net payment cost index. So we take total payments, we minus out dividends. Both are accounted for the time value of money. We get a net insurance cost. Notice we don't do step 2, which is where we take out cash value in both the first two methods. Then we divide by that function of what a dollar would grow by, which is exactly the same as step 3 from the surrender cost index method. And then step 4 is the same for all three methods, right? We're dividing by the thousands of dollars. So if there's 100,000, it's dividing by 100. If it's 50,000, we're dividing by 50. If it's 10,000 like this one, we're dividing by 10. And that gives us the cost per $1,000 per year of insurance using the net payment cost index method. Now, just as a general rule for purposes of the assignment, just like this problem that we just looked at on the slides goes smallest, next greatest, and then greatest in order as far as the value that you're going to get as your answer. You're going to get the smallest answer and sometimes even negative on the traditional cost index method. For the surrender cost index method, you're going to get a bigger number. And for the net payment cost index should be your largest number every single time you do this, no matter what the policy issues are. Okay, so if you're looking at the same information and using these three different types of cost methods for calculation, you're going to get your largest number on the net payment cost index, your next largest number on the surrender cost index method, and your smallest number on your traditional cost index method. Okay. I hope you were able to take a few notes on those formulas. The formulas are also in the chapter, but I think these examples on the slides are the easiest way to do it. If you'll maybe re-listen to what I'm talking about when you try to go through and calculate them out, I think that'll help. Okay, excuse me. Some water. All right. So, why does this all matter? Who cares? So we can do some math. Well, the math matters because if you go back 20 years from 2008 back to 1988, they've got data based on different types of policies from different major companies that shows us the actual surrender cost for these different types of policies. And what I wanted to illustrate and what I mentioned earlier is you may have a policy that has a low premium, but that doesn't mean that you're going to get significant value from that policy. In fact, in many cases, it means that you won't get significant value. So remember what we talked about, how the lowest surrender cost index is the best, okay? The lowest surrender cost index. Not the premium, right, but the lowest surrender cost index. So the lowest surrender cost index among the different policies here that you're looking at on the index actual, so there's one that they illustrated, but then there's the actual surrender cost, which you'll notice in every case almost is higher, okay, which is interesting. But the lowest surrender cost index on the actual side, on the actual column, which is that third one in, okay, the third one in as far as the numbers here, the lowest one here is Savings Bank of Massachusetts, okay. Savings Bank of Massachusetts also happened to have, well, no, it didn't. This is a good example because it didn't have the lowest premium. If you'd have just gone off premium, you'd have gone with National Life, right? Because that had the lowest premium at 4080. And, oh, by the way, it had the highest actual cost in the end. So the one with the lowest premiums, the lowest cost to you each month in premiums, actually had the highest internal cost. Okay? So this is something really important to keep in mind. Because when you're dealing with whole life policies, it's tempting to just go with whatever policy, as far as cash value policies are concerned, that has the lowest premium. That's what we're conditioned to do as consumers, right? As consumers, we're always conditioned to go with the lowest cost if things look the same. But all these policies were exactly $250,000. They were on the same person, and everything looked similar from the beginning, except, you know, National Life had the lowest cost, this annual premium. But as far as its actual internal cost to you, it had the highest actual internal cost. policies that sometimes are the highest, like the company I used to work for, like Northwestern Mutual, happens to be the highest premium, happens to be one of the lowest costs. It's the second lowest cost after Bankers Life of Massachusetts, okay, for that 20-year period. Okay, you'll probably recognize some of these different names on there. Ron, welcome. It's good to have somebody. Thanks for joining in. Can you hear me okay? Hello, Ron. Maybe you're not up and running yet, but thanks for being here, Ron. All right, welcome. We're just talking about different methods for calculating cost of life insurance and then why that's important. And this illustration that we're looking at right now, this slide that should be Exhibit 13.4, hopefully you're seeing on your end, the numbers might be small, but you should be able to see different insurance companies. And if you look at the annual premium column, you'll notice that the most expensive policy as far as the premiums was Northwestern Mutual's 90 life policy at $58.15. But then if you go another 2 columns over, it was one of the least expensive from an actual surrender cost index over those 20 years. So that accounts for dividends and cash value. That means that Northwestern paid a lot more dividends and cash value back to you over that 20-year period of time than most of the other companies did. That's why you pay more in, but you actually get more back. The most efficient policy on this list is the one that's got the lowest surrender cost index actual column, so that third column over, and that would be Bankers Life of Massachusetts. You'll notice they weren't the least expensive policy. They were at $4,388, right, per year. The least expensive one was the National Life policy, that Apex 2 policy, at $4,080, but it actually ended up being the most expensive policy you could have bought as far as internal costs and value associated with the policy. So all we're trying to illustrate here is that the difference in premium is a little bit deceiving, right? If you just go out and pay for the smallest premium life insurance policy, you may not be getting the best value back. In fact, you probably aren't, because the least expensive premium policies here were sometimes the most expensive as far as internal value and costs are concerned. So we just got done talking and comparing different costs, how we compare and calculate those different costs. You'll need to know how to calculate them for the assignment this week, Ron. And so I'll let you go back to the slides or back to the session to catch that first part in order to get caught up on doing those calculations. It's also in the book. Ron, just a quick question, because I've had some other, I've had one person check with me this week, and are you able to access the ebook okay? Or have you been able to so far? The reason I ask is because I noticed that it's not in the normal place under pages. Okay, so you uploaded it. Were you able to just go into the normal ebook site though and just flip through it like you normally can, or did you have to go somewhere else to get the upload? Okay, perfect. So that's what we've got to do, is go under modules and then go under the ebook, and then it should pull up. I should be able to get to both chapters 13 and 14 there. Chapter 13 will be very important this week to help you out with the assignment and, of course, for the test as usual. All right. Thanks, Ron. Good thing you're here. Okay, let's keep looking at things. All right. So basically, life insurance has some regulations associated with it. They're regulated on what they can show. But just know that even though they're regulated on it, they still can be fairly optimistic in what they show you on their illustrations. So in that previous slide that we were looking at as far as costs, it allowed an insurance company to illustrate what they expected their surrender index cost to be. And you'll notice across the board, all of them were a little bit too optimistic. None of the policies, none of the companies actually lived up to their illustrations. So just be careful when you're getting an illustration from an agent that you're trying to be as realistic and conservative with that illustration as possible, because sometimes it's not as good as it should be. Here's an interesting slide. Average annual rate of return based on a policy. If you buy a policy and you cash out after 1 year, you're going to lose a lot of money. Okay? If you cash out after 2 years, you'll probably lose a lot of money. If you cash out after 3 years, you'll probably lose a lot of money because most of the costs associated with whole life cash value insurance are baked right up front. This illustration is a little bit generous in my mind, in my humble estimation, based on the illustrations that I've seen in the past few years. Usually the break-even's closer to 7, 8, or 8 years on most policies, where you're not getting anything back unless you go beyond 7 or 8 years. And after that, it ends up in the 5s. This is an older exhibit based on higher crediting rates and higher cash value interest rates. Nowadays, interest rates have come down so far that this, like I say, would take 7 or 8 years to get to the break-even on rate of return for cash value. And then beyond that point, it usually ends up kind of settling out in the 4s and 5s, not the 7s and 8s like this illustration shows. So just as a heads up. Wanda, welcome. Thanks for joining. All right, we're just talking about different life insurance policies, costs of life insurance. Some people say cash value life insurance is a bad idea. It can be okay as long as you're long term, right? If you're short term with life insurance, you're gonna get smacked around. So if you have a policy for 2 or 3 years and then you cancel it, you got hosed. If it's cash value life insurance, if you hold on to it for 20 or 30 years, it can be a great thing because cash on cash, it can give you a nice rate of return. So how do you get the yearly rate of return based on the cash value? Here's the formula. We're not going to go through it here. Prices of insurance, okay, per $1,000. You can see price of insurance per $1,000 if you're under 30 years old is very cheap, only $1.50 per thousand per year. If you're 80 years old, it's $125 per thousand per year. Okay, it's pretty expensive when you get into your 80s, right? And we know that. I mean, the older you get, you would expect that the insurance company is going to charge you more. Cost of insurance will go up the older you get. That's why if you can lock in a good policy when you're young, that's a great thing. Taxation of life insurance, just keep in mind, and the book describes this as well. Life insurance death benefits pay out 100% tax-free to the beneficiary. So if you have a $100,000 policy, and when you die, it goes to one of your children, that $100,000 will come out 100% tax-free. The only time that there's an exception to that, as far as the death benefit, is if you have a group policy through work, there's a chance that part of that policy will be taxable. Okay? But as far as regular individual life insurance, the death benefit is 100% tax-free. Now, if you leave the death benefit with the insurance company and it grows some interest, that interest will be taxable as income, of course. But as far as the original death benefit, that will come out tax-free to your beneficiaries. It's one of the most efficient estate tax planning products that's available. In fact, I would say it is the most efficient tax planning estate planning product available. So somebody who wants to transition money to their children, grandchildren, to charity, the most efficient way to do that from a tax planning standpoint is life insurance, unless you're uninsurable or unless you just can't get insurance for some reason. Okay. Let's see. Talks about estate taxes. Okay, let's go through just real quick. Just want to show or point out this list of issues as far as buying insurance. Goes through a step-by-step process. First, you need to know whether or not you even need it, then how much, then what type. Now, once you get to about step 6 or 7, that's when you finally talk to an agent, right? You've done all your homework. You know what you want before you go and talk to an agent. And this is important with any large purchase, right? Any financial product, anything that you go out and buy. Much better to have a good understanding of what you want before you talk to somebody who's trying to sell you things than wait, talk to them, allow them to sell you, because they're going to always try to sell you the biggest thing they can. So the same thing is true if you go onto a car dealership, right? If you have no idea what car you want, you have done no research, okay, and you allow them to sell you, they're going to sell you the thing that makes them the most money, of course. And you would expect that. You should expect that. That's why we need to be a little bit more educated consumers. We need to go through these other steps, determining how much we need, determining what type of coverage, determining dividends or not dividends, cash value or not cash value, and then finally at that point, then go to an agent and get them to give you some options. Okay. Insurance companies are rated by rating companies, Best, Fitch, Moody's, and the S&P. Your biggest life insurance companies like New York Life, Northwestern Mutual, Mass Mutual, Pacific Life, those big companies, almost all of them have very, very high ratings for financial strength. You have a lot of smaller companies that have lower ratings. In my years in insurance, I rarely ever saw 16 or lower, that rank number 16 or lower, any of those C's or triple C's. I saw a lot of A's and double A's, okay? So maybe not the best, but that third, fourth, or fifth tier, and those are all very good ratings. And why does it matter? Well, this is a commitment that an insurance company is making to you that might be 50 years from now or 25 years from now, right? So it's just hugely important that we have confidence that that insurance company 25 years from now, no matter what the economy does, is still going to be in good shape and is going to pay out the beneficiary, right? Pay out our beneficiaries. Because it's a promise from that insurance company, and the promise is only as good as the company, right, that stands behind it and how well they are doing. Okay. That's chapter 13, or at least the information from chapter 13 we wanted to cover. Wanda, before you came, we talked about methods of calculating the cost of insurance. And the reason that's important in the first 10 or 15 minutes of class tonight is because your assignment this week is going to have you demonstrate that you understand how to do those calculations, the calculations that we reviewed slides for. So either review the slides really well or go back to chapter 13 and make sure and review the part where it demonstrates, shows you how to calculate using the traditional cost index method, the surrender cost index method, and the net payment cost index method. So those are the three ways that you calculate costs, actual costs of insurance. Okay, so you have premiums, that's how much the insurance company is going to charge you, right, to have the insurance. But then you have these actual cost methods that help us to evaluate how much value we're actually getting for the policies, right? And that's way more important than what the premiums are. All right, we've got a few more minutes. We've got about 20 minutes to cover annuities and IRAs, so we're going to spend a few minutes on this. Like I say, the discussion board this week is on annuities, and hopefully you'll do some research and find out some information on what annuities are and how they work. There are very strong opinions on both sides of annuities. You have people that think they're the best thing in the world, and then you have people who are very anti-annuity. Now, most of the folks who are pro or against, unfortunately, have an agenda, right? Folks who are really negative about annuities are usually trying to sell you something other than annuities. People who are really pro about annuities and think they're great are usually the people who are trying to sell you annuities. I would say that the answer probably is somewhere in between. Annuities are not Satan's product, as some people would have you believe, which I know is kind of extreme, but they really come out with guns blazing when it comes to what they say about annuities sometimes. I think there are very decent and good annuity products, and for certain situations they make a lot of sense. But just like any insurance-based product, they do get oversold. And because they get oversold, a lot of advisors and financial gurus tell you to steer clear, of them instead of getting sold by an insurance person something that you don't necessarily need. Okay? But if you're a good consumer and you've researched and you know that this is what you want, it can be a very good and decent product. All right, so let's talk a little bit about annuities and IRAs. So an annuity is a periodic payment that continues for a fixed period or for a life or lives, okay? So in a way, the Social Security program is an annuity, right? It's an annuity payment that will last for your life when you start taking Social Security. That's an annuity, okay? That's the general definition. When we talk about annuities, the products, sometimes this gets people a little bit tricked up because they think that no matter what the product is, it's always going to give us income for life. Some annuity products do not give us income for life. Some annuity products just give us a guarantee for a certain period, and then we cash them in just like a CD, okay? So those are just fixed guaranteed annuities. Then there are fixed index annuities, and then there are variable annuities. So FAs, FIAs, and VAs. Fixed annuities, fixed index annuities, and variable annuities. Okay, those are the three main types of annuities that are available at this point. Fixed annuities work very similarly to CDs. They're not FDIC insured. They're not through a bank. They're through an insurance company. But basically, they're just a time period, like 3 or 5 years, that they give you a guaranteed interest rate, and then when it's over, it's over. You take your money and go do something else. Fixed index annuities are a little more complicated. They usually base the credit that they're going to give you on something like the S&P 500 index, or like the stock market or the bond market or something like that, or a mixture of the two. They're not actually invested in those instruments, but they are using those instruments to determine what kind of crediting rate they should give you. They're fairly complex products. I'm not going to go into all the details, but make sure that if you ever are going to do some product like that, that you really understand the ins and outs, all the fine print, and make sure that you have your eyes wide open before you get in. A lot of people get into those types of products, got sold all the advantages, and don't really understand the ins and outs of a fixed indexed annuity. Variable annuities are pretty straightforward. That's where you do invest in the market or some portfolio, and then how your annuity does is going to be based on how those underlying investments do. A lot of variable annuities will have the ability to add riders that give some kind of minimum guaranteed income in the future, okay? But they don't usually give you some kind of minimum guaranteed withdrawal value, meaning money that you can just pull out whenever you want, okay? Most all annuities tie up your money for a certain amount of time and have some kind of surrender cost for getting out early, so just keep that in mind. Most annuities have higher costs in general than regular investments, but most annuities have some kind of guarantee or extra guarantees that can be added to them that regular investments don't have. So there's lots of advantages and disadvantages associated with annuities, but in a general sense, annuities are just, the definition of an annuity is just something that pays over time, but you need to understand that annuities, when it comes to the products, can be all kinds of different things. So one of the big advantages of annuities is that they're tax deferred, okay? That's also a big advantage of IRAs. They're also tax deferred. So when you look at this chart, you can think in terms of annuities or IRAs, okay? Tax deferral over a 10-year period of time gets you a little bit better overall investment value return. When you go out 30 years, deferral, having something tax deferred over a 30-year period of time, you can see the difference between these two numbers is $80,000, okay? That's a significant difference in the return that you get over the long term if you have tax deferral. Annuities provide tax deferral, so do IRAs. Okay, it's a big tax advantage of both. Fixed annuities, like we talked about, just give guaranteed income payments or give guaranteed interest payments, one or the other. Okay. Immediate annuities pay right now, deferred annuities pay in the future. Pretty straightforward. A lot of this stuff you're going to be learning in the chapter, or excuse me, on the discussion board, so I'm interested not to cover it too much in detail. Variable annuities, like we talked about, can pay lifetime income, but are dependent on whatever investments you put inside of them. Okay, so they might not be guaranteed to go up by a certain amount, although you can add extra contract features that add guarantees for a cost from the insurance company. Here's some immediate annuity options on $250,000 if you were a male at age 67. You could take $17.91 for life until you died, and then there's nothing else that would be there. So if you died a year later, right, you'd pull about $20,000 out of that, and $230,000 would go back to the insurance company. All the insurance company is doing is guaranteeing you that they'll pay for the rest of your life. So if you live a really long time, you win. If you live a short amount of time, you lose, right? Now, an important concept to understand, and the reason that why annuities are always offered by insurance companies, life insurance companies, because actuarially, life insurance and annuities are exactly the opposite from a risk standpoint. So, what do I mean by that? Annuities are trying to protect you from living too long. Life insurance is trying to protect you from living too short, okay? When you think about it, that's exactly what they're protecting. Because those offset one another, it makes a lot of sense for a life insurance company to have both annuities and life insurance on their books because they have offsetting risks associated with them, okay? If somebody lives to 110, their insurance policy will not pay out, right? If it's term insurance. If it's whole life, it's a lot more time for the insurance company to accumulate value, and they won't really lose money on a deal like that, okay? But if you live to 110 in annuity, you will make the insurance company lose some money on you, okay? The other way around, if you die too young, the insurance company is going to lose because they have to pay out the life insurance, but they're going to win on the annuity side because they don't have to pay hardly anything out. Okay? Now, there's lots of other options, and most people do not only do the life income with no refund, meaning they don't want to risk having it pay out for 2 months and then pass away. They'll do guaranteed periods of like 5 years, 10 years, 20 years, so that income payment will at least go for 20 years before they pass. So in the case of the life income with 20 years, right? If you get about, let's just call it $18,000 a year over 20 years, that's $360,000 worth of payments, and you put $250,000 in, you know for sure that you're going to get your money back plus some, right? So that's a way to guarantee that, although it does pay less than the single life income option. Here's some low-cost variable annuities. These are about a third of the average cost of other annuities that are out there. So this is a good resource if you were looking at variable annuities as an option. Although this isn't a class where I'd like to do any advertising for other companies, so we'll move on. Then we've got the EIAs, fixed indexed annuities, or equity indexed annuities as this is called. I call them FIAs, and that's what they're usually referred to. Taxation is kind of interesting on annuities. Make sure you understand it. You've got what's called an exclusion ratio, where you take the investment in the contract, or your basis, put your money in, you divide it by the expected return, and that gives you your exclusion ratio. That's the ratio that you don't pay taxes on, okay? So if it's 0.4, the exclusion ratio of 0.4 or 40%, 40% of the money that comes out of the annuity payments is not taxable, 60% is taxable. So your exclusion ratio is the amount that is not going to be taxable of the amount that they pay you. It's representative of the amount that you put into the investment. So like other investments, if your money that you put in won't be taxed when it comes back out, you'll just pay taxes on the growth or gain. But obviously there's got to be a little bit different equation because they're paying you over time, right? So that's where you get to that exclusion ratio. Then we get to what's called individual retirement accounts, or IRAs or IRAs, okay? All three are correct. You can refer to them as individual retirement accounts, the long name. You can refer to it as an IRA, or you can refer to it as an IRA. Any one of those three is perfectly normal, and they're used quite regularly, but they're all referring to the exact same thing. These are accounts allowed by the federal government to defer taxation on retirement savings, okay? They work. A regular IRA works exactly the same from a tax planning standpoint as a traditional 401k. A Roth IRA works exactly the same as a Roth 401k from a tax planning standpoint. And this is the basic difference. Traditional IRAs, you get an upfront deduction when you put the money in from taxes, and it grows tax deferred. Then when you pull the money out, you have to pay taxes on them, right? All the money that comes out, you have to pay taxes on. So it's nice because you get an upfront deduction. It's nice because it's tax deferred. But when you take the money out, it's 100% income taxable, okay? A Roth IRA, very different. You don't get any upfront deduction. You do get tax deferral, and when you retire, you get 100% of your distributions 100% tax-free, okay? Why does this matter? Well, if you put $10,000 in at age 25 and you grew your money at 10%, every 7 years you would double your money, okay? Every 7 years you would double your money, and you've got about 40 years before you retire. Let's call that 6 doubles, okay, before you retire. So that 10,000 would grow to 20, 40, 80, 160, 320, $640,000 if you doubled it 6 times over your working life. If you doubled that $10,000 account 6 times because you averaged a 10% return. Now, you've got $640,000 from your original 10,000. You never paid taxes on it because it was in a Roth IRA. It grew 100% tax-free. Then when you take the money out, even though $630,000 of the $640 has never been taxed, the IRS allows you to pull that out for retirement 100% tax-free. You will never pay tax on it. It's pretty much the only vehicle under the sun where the IRS doesn't at some point get taxes from you on them. That's the beauty of a Roth IRA. If you have a long time before you retire, Roth IRAs are the most tax-efficient vehicles for retirement savings that you can possibly do, okay? If you're closer to retirement, then it might make sense just to get the traditional IRA tax benefit up front with the deduction, depending on what you expect your income to be in the future and how long you have before you retire. So it's a little more unclear the closer you get to retirement whether or not a Roth or a traditional IRA is better. When you're younger, it's a slam dunk. growing your money 100% tax-free and being able to have the value, the advantage of compounding interest over years and years and years is going to be great for you if it's in a Roth IRA. Okay, so that's the difference between Roth and traditional IRAs from a tax planning standpoint. Traditional IRAs have some rules, of course. Distributions are taxed as normal income, like we talked about. You have to start taking what's called required minimum distributions, or RMDs, starting at age 70.5. It's a weird age, I know, but at 70.5, the IRS starts mandating that you take at least a minimum distribution out. This minimum distribution starts at about 4 1/3% of the account. So it's not a lot, but it ratchets up a little bit each year. And basically the idea is the IRS wants to tax your money, right? They don't want you to just keep it in the account forever. They want you to have to start pulling it out so they can tax it. We're in 2016 now, so it's been a long time since this was made. Now we're at $5,500 and $6,500. So $5,500 per year is the cap on traditional and Roth IRAs. Okay. And if you're over 50, you can do $6,500. Okay, so it's a little bit higher than when this slide was made. Okay. Roth IRA contributions can be made after 70.5. Traditional IRA contributions cannot be made after 70.5. Roth IRA doesn't force you to take distributions out because the IRS doesn't care whether or not you take the money out or not. They're not going to get any money either way, right? Because they're not taxable. They care about the traditional IRA balance because they want to tax it. Roth IRA, you can leave it in there as long as you want because you're not going to be taxed on it. Okay. Traditional IRAs can be converted to Roth IRAs. However, at the point that you convert them, you have to pay ordinary income tax on the entire balance that's being converted. So if I have a $100,000 regular IRA and I want to convert it to a Roth IRA, I will realize $100,000 worth of income and pay taxes on it that year in order to convert my account to a Roth IRA. So it's a very costly transition or conversion from one to the other from a tax planning standpoint. However, could still be very well worth it, and you can pay the tax out of the account. It doesn't have to come out of pocket. Okay, so not very many people would be able to come up with $40,000 out of pocket to make that conversion, although if you can pay it out of pocket, but you can also just pay it out of the account. Here's the basic differences between the two. It's a nice slide just to reference differences between traditional IRAs and Roth IRAs. Excuse me. All right, I think that's all we want to cover. Yep. Okay. I had mentioned early on in the class tonight that the test this week has more problems than last week did. It's worth more points, worth about 100 points this week instead of 50. Let me just pull it up here real quick. So this week you've got 25 questions. If I'm not mistaken, they're all, though, from chapters 13 and 14. It's not a comprehensive one. There might be a couple from the chapters last week, but most all the questions are from this week's information. Okay, so here are the topics that you need to know for this week's test. First of all, number one is a surrender cost method calculation. So at the beginning of the class tonight, we talked about the traditional cost index, surrender cost index, and net payment cost index methods. Number one is just it gives you the information you need, and it needs you to plug that information in and calculate the surrender cost index method of the information that it gives. Okay, you'll get some practice on this on the assignment. If you do the assignment prior to the test, I would strongly encourage that. Number two on the test is asking us about the different options for annuities. We gave you that graphic that showed you the different payments based on different payout types. One of them was just single life. One of them was single life with 5-year, 10-year, 20-year guaranteed periods. One of them was a joint life benefit. Anyway, you go down that list and you can see there are different values based on which decision you choose. For number two on the test, you need to know which one is consistently the highest. Which option among the annuity options that you can take is consistently the highest? And if you know that, you'll get number two right on the test. Number three on the test, you need to know the basics of the inflation index annuity option. What is the inflation index annuity option? What does it mean? What does it do? That'll get you number three right on the test. Number 4 on the test, the joint and survivor annuities. You'll want to know what that means. What does it mean to have a joint and survivor annuity? Pretty straightforward, but just freshen up on it in the book and you'll be in good shape for that one on the test. Number 5 on the test has to do with the penalty associated with taking money out of a traditional IRA prior to 59.5. Just make sure you understand what the book has to say about taking money out of IRAs prior to 59.5 and maybe what the exceptions to that penalty are. Okay? So just as an aside, you pay a 10% penalty if you take money out of a traditional IRA before 59.5, but there are some exceptions. You'll want to know the basics of what that penalty is and how that works before you get to the test to get number 5 right. Number 6 on the test, you've got different fees associated with variable annuities. Just make sure you understand what the different fees are. So the book goes through what the different fees on a variable annuity are. Just make sure you understand what those fees and expenses are, why they're there, what they are. Number 7 on the test is taxation on an annuity. Make sure you understand how annuity distributions are taxed. Okay, we talked about the exclusion ratio for annuity payments over time, but also you need to understand if you were to take a one-time distribution or lump sum distribution from an annuity, how is that taxed? Okay. Number 8, we talked about the risk associated with life insurance and then annuities. Life insurance, the insurer is risk pooling excessive longevity, right? People living too long. Or excuse me, not excessive longevity, the premature longevity, right? People living too short. Annuity risk pooling is excessive longevity of living too long, right? That's what they're trying to protect us against. So that's why insurance companies pool. They don't want to take on just 1 or 2 clients. They want to have thousands of clients, because if you have thousands of clients, then the numbers work for you, right? Yes, you're going to have some outliers where people live too long, but most people are going to die at the average mortality, right? Either a little longer or a little shorter, but they're going to be able to do calculations based on the average mortality. We'll want to know that you can calculate just really basic numbers on an exclusion ratio. Remember, we talked about how to calculate that. Talked about basis, okay, the amount we paid in over the years, right? Basis over the years to give us the exclusion ratio. But there's also a slide that shows us that, right? Let's go back to exclusion ratio really quick if I can find it. Nope, I must have skipped it. Sorry, I just want to look at it, make sure. So the investment in the contract over the expected return, that's how you calculate the exclusion ratio. I think I misstated that. Investment in the contract, the basis over the expected return, that equals your exclusion ratio. Make sure you understand how to plug those numbers in. You're not going to have to do some really hard calculation, but you'll want to be able to calculate an exclusion ratio. Number 10 on the test has to do with exclusion ratios and taxation of annuities again, so just make sure you understand the basics of that. Number 11, you want to know the basics of Roth IRAs. So just study through the graphic a little bit on Roth IRAs and look to the chapter on Roth IRAs and you'll be in good shape for that one. Number 12, on what they call an equity indexed annuity, what I've been calling a fixed index annuity or FIA. You want to know basically what is the method to getting interest credited to the annuity. What are we crediting to the annuity? You'll remember that I mentioned that in these types of contracts, they are not invested in the market, but they give you a credit, an interest credit based on some equity index or some kind of index that they're tracking. Okay. Number 13 on the test has to do with charges associated with variable annuities. Again, second question on that. Just make sure you understand the different expenses and fees and why they're there, what they are. Make sure you understand what life annuities are trying to do. What are the objectives or purpose of doing a life annuity payment? Number 15 on the test, Roth IRAs versus traditional IRAs, just the basics of the differences between Roth and traditional IRAs. That graphic, again, that we showed you tonight, that the book has, that just compares and contrasts life IRAs and Roth IRAs. Immediate life annuities, pros and cons, advantages, disadvantages. Basically understand what is an immediate life annuity How does it work? What are some of the advantages and disadvantages of doing that? Number 17, you'll want to understand the difference between the net payment cost index method, the surrender cost method, and the traditional net method. Okay. Net payment, surrender cost, and traditional net cost methods. What are the differences between those? I went over for the first 5 or 10 minutes of the class tonight the differences between the two. They all have 4 steps except the net payment method. The net payment method skips step 2 that we talked about. So it only has 3 steps, but the first 2 methods have 4 steps just like each other. Some of them have crossover between each other and some duplication in what they're looking at, but all of them have a little bit different from the others, right? Or we wouldn't have 3 different methods. So we just need to know the basic differences between them before we get to number 17 on the test. Number 18 on the test, just want to know what the marital deduction is. What is the marital deduction? What does that mean? Number 19 on the test, just know what terminal reserve is on a policy. What is terminal reserve? Number 20 on the test is a question about the yearly rate of return method on life insurance. What is the yearly rate of return method on life insurance? Make sure you understand how to calculate what goes into gross premium. What is the calculation that goes into gross premium? What does the book have to say about that? Number 22, you want to understand what you do with life insurance as far as estate planning is concerned, whether or not to include life insurance or to exclude it from your gross estate, how you do that. How do you have life insurance in your gross estate versus out of your gross estate? Number 23 is a calculation based on the net payment cost method. Number 24 is a calculation based on the traditional net cost method. So you're gonna do an example problem on all 3 different methods within the test. So just make sure you've run through that. The best way to do that would be the assignment before you get to the test and practice through that so that you feel comfortable, that you can go through them. The assignment will have you do it 2 or 3 different times so that you can get, kind of down those 4 steps over and over and over again for those 3 methods and the differences between them. Number 25 is just the difference between net payment cost index and surrender cost index methods for the cost of insurance calculations. Okay, so those are the 25 questions on the test. Ron, Wanda, I know that was fast, but any questions about maybe numbers that you missed on the test? Repeats that I can give you so that you feel like you at least know the topics before you get to the test this week? Any questions in general about life insurance, about these different cost methods, calculations? Okay, just keep in mind for if you don't remember anything else from this particular session, keep in mind that the difference between 2 policies, whole life insurance or universal life insurance, has less to do with the premium, okay? Less to do with the premium and more to do with the actual internal cost of insurance, okay? So less to do with the premium, more to do with the cost of insurance. And unless you calculate that, you're going in blind, right? You could be paying a low premium relative to another company, but that doesn't mean that you're getting the most value for your money. The most value for your money might be with the more expensive policy, just like anything else in life, right? Sometimes when we pay a little bit more for something, we actually get better value for what we pay into it. Okay, that's tonight's lecture. That's tonight's discussion. Good luck this week. Let me know if you have any problems or concerns, questions, get stuck on anything. Best of luck to you. Take a look at the assignment early in the week this week. Do not wait until Saturday night. It will surprise you. It's a little more complex, a little more complicated than past assignments, so we'll want to make sure that you have enough time to complete it and do a good job on it. All right, have a great evening. Good night, everybody.